Howdy, Team 42. Your skipper here, Darius Dale, to present our Around the Horn Weekly for Saturday, October 23rd, 2021. As you know, we got a ton of content to get through, so let's just hop right into it, starting with the key takeaways on slide 3. Short term, the setup heading into next week is not especially favorable for a variety of reasons. First, you have global equity. U.S. and global equities are generally overbought. Second, bonds are not generally oversold enough to provide a meaningful countercyclical impulse to investor portfolios after Friday's massive up day in the long bond. Third, the dollar is oversold and a bounce could catalyze a bit of a disinflationary impulse. Lastly, IVOL discounts in the SPY -7%, Q -5%, and the ACWI -5% point to an increasingly brazen investor consensus that may be overdue for a lesson in taking profits. From a medium-term perspective, however, we continue to believe dips will be shallow as bears are likely trapped and need to performance chase into year-end. While our post-Delta bounce view was marginally disconfirmed by some leading survey data this week, notably the European flash PMIs, U.S. flash manufacturing PMI, yet the Philly Fed, and the Langer Consumer Confidence Index all ticked down, we still maintain conviction in the theme and the view that the growth data are likely to bounce on the other side of the peak impact of Delta. As such, risk assets likely have upside into and through year-end. We believe net liquidity is likely to inflect lower in mid to late Q1, which is right around when our monthly grid model projections anticipate steeper decelerations in U.S. and global growth. That obviously is bearish. The confluence of those will be very bearish, in my opinion. Until then, investors on Team 42 should remain cautiously optimistic on risk. Obviously, a ton of downside risks. We're very well aware of those and quantifying them, but we certainly believe that markets are likely to continue to have a positive resolution to the upside with respect to those risks. Lastly, from a portfolio construction perspective, all those faux overbought signals from last week's presentation worked like a charm in terms of giving us the patience to avoid making a premature call to hedge near-term downside risk. Our grid model portfolio construction was once again handsomely rewarded by the market gods. This week, our improved probable range model is generating a litany of actual overbought signals. You got an overbought signal in defense, DEF, broad U.S. equity beta in general, EUSA, RSP, VTI, mega cap growth, MGK, NASDAQ 100, QQQ, and then obviously I mentioned this, the oversold signal in the dollar. So let's just get right into the presentation. All right, so starting with our portfolio construction on slide 4 here. No changes. We love when there are no changes. That means it's working. This thing's working like a charm. In terms of global macro risk matrix, nothing really to highlight in terms of late last week. We did have the Russell break back to bullish late last week, but that's really the only thing of substance to highlight. On slide 6 here, some of confirming markets. So reflation is in the driver's seat with 16. That's off its trailing 3-year peak of 13. And obviously the conviction in the consensus narrative, which is now reflation, in my opinion, or in our model's opinion, is only 10%. It's a very low conviction reflation regime. You know, this was a very high conviction reflation regime, 99th percentile in terms of overall conviction. At the, in the sort of early part of June, we called that out and said, hey, we think inflation is a little bit crowded here. And obviously we saw some pretty meaningful corrections in it across some very consensus inflation trades. Then this right here is not that. So we have some time, in our opinion, to get to something that resembles a little bit more of this in terms of share confirming markets. Inflation's, obviously the modal outcome now, but one could go higher. But more importantly, I think the conviction, the narrative is something that we think will build as we progress throughout Q4 and start to resolve some of the bearish risks out there, or at least at the bare minimum, get past them in terms of, selling eyeball and things of that nature. On slide 7 here, looking at dominant market regime. So inflation's back in the driver's seat. I mentioned that. One thing we called out at our notes this week is that, hey, we've been calling this out for a while now, is that, hey, look, CACRI really hasn't been in the danger zone since early June. This whole period throughout the summer and into the fall has really been, sort of characterized by middling to elevated CACRI readings. In our opinion, the high CACRI readings were telling you that, hey, look, the CTAs, the quants, the macro funds that all sort of dial up and dial down their leverage at various intervals in the market cycle are likely not fully positioned for a reflation trade or very positive resolution of stocks. And so that's why we got this sort of 5% correction, just V-bottom straight off of it. In our opinion, we think that was a very instructive signal in terms of confirming the efficacy of the process, right? We don't build tools just to sell you tools. It's not the point. We build tools to sell you tools that work. And we do believe CACRI to work like a charm in terms of the risk managing the most recent correction and having the confidence not to go full blown bear like a lot of people did at the lows of September and October. Slide 8 here, looking at positioning. So we got more positive signals for our U.S. equity exposure. I think in terms of the Dow. So we see this 20,539 month over month delta. That's a 2.2 Z score historically on an average 1 month forward basis. Whenever you trigger that 2.2 Z score on a 1 month delta basis, you typically see performance, 1 month average performance for the Dow specifically up, just shy of 3% on a 1 month basis. Obviously, if the Dow goes up by 2.8%, which I'm not saying it will, you're going to see the rest of U.S. equities doing quite well in that scenario as well. And then you got a raging buy signal in Bitcoin. And I'll caveat this by saying, clearly the BITO ETF, the ProShares Bitcoin Futures ETF, is going to have some impact on these market dynamics with respect to Bitcoin. I think it's too early to tell, to reasonably conclude and say, hey, this is how it's exactly going to impact it. So there's maybe something to be take what I'm about to say with a grain of salt. But in terms of Bitcoin, you have a pretty material a week over week drawdown in the net short position. So it started net short and got even more net short. Historically, that's been extremely positive on a 3-week forward momentum basis. Same thing on a month over month delta. That's also historically been quite positive. And you have the same thing on a 3-month delta. The 3-month delta in this Bitcoin net speculative futures and options length is down 1.7 thousand contracts on a 3-month basis. That's a minus 2.5 sigma delta. The mean 6-month 4% performance, whenever you see a minus 2 sigma delta on a 3-month basis, is 103%. So that kind of rhymes with my call that Bitcoin's going to 100,000. I don't think I'm alone in that view anymore. But I certainly believe that, if you're just looking at the math and the data in the last 10 years of market history, it's telling you that the market is set up for a meaningful rally in Bitcoin. But again, take all this data for what it's worth. Obviously, this is, CFTC futures and options data. It's probably the least predictive in terms of all the market signals that we're generating, but it's definitely instructive at various points in the cycle. This is why it's part of the toolkit. On slide 9, looking at crowding analysis, dispersion between defensive assets and risk assets is all you need to be 42 macro aware of heading into next week. You got the eyeball premium of 35% for defensive assets, 2% for risk assets. Obviously, SPY, ACWI down there by themselves and with eyeball discounts. Crowding on the micro side, we're likely to be buyers of base metals on a more material shakeout. They've corrected, but we'd like to see, in terms of the speed of the up move, we'd like to see a little bit more of a correction, especially given that the dollar is at the lower end of its probable range. We're not trying to be cavalier buying base metals here with the dollar at the lower end of its probable range and a lot of U.S. equity, just equity beta type exposures, at the upper boundary of their probable ranges as well. Slide 10 here, looking at crowding in aggregate. So you got a healthy eyeball premium and short-term volatility. That's the VXX. Where's the VXX right here? You got to squint to see it. Trying to get 50 different exposures in the chart. So excuse my tiny font. I think you guys can appreciate the tiny font and more exposures versus less exposures and bigger font. Some of you, I know it gets harder and harder to read as we get older. I'm certainly learning that, hence the glasses. Anyway, but at least I'm calling it out for you, for those of you who can't read that. Dispersion, pro-cyclical still in terms of the composition of the upper quintile relative to the lower quintile. It's something we've been talking about for over a month now. Stock picking is back. You got a lot of shorts working, right? Most shorted growth's working. SPACs are working. I think most people are short those at this point. Most short at low debt, high short interest, most short at low beta. So shorts are working in earnings season right now. And that's telling you stock picking is back. And we set this going back to my Real Vision interview with Ed Harrison back in mid-December of last year. I said the third quarter of 2021 is going to be when investors start to differentiate between post-pandemic winners and losers. Between now and then, again, I'm saying just be ragingly bullish on everything because it's, everything's going to go up. All the rising tide of growth and inflation going higher alongside easy monetary and fiscal policy will lift all boats in terms of corporate profit growth. But third quarter is when it inflects lower. When that inflection lower is really going to start to look forward into 2022 around, how fast will some of these companies decelerate from a revenue and growth standpoint, who can handle supply chain issues better versus worse, things of that nature. And we do believe shorts are working for all those dynamics. So it's macro has been dominant, really since going back to the beginning of 2020. That's not, it's slightly becoming less dominant, which I would argue is a positive factor for the market in terms of, actually differentiating and giving, rewarding investors with capital. And then lastly, you got people sucking money out of Facebook to buy Netflix and Tesla and energy and financials and things like that. I mean, this thing is a dog. I mean, they got a lot of problems that I can't pretend to comprehend or give you advice on. Not that I actually want to. Just talking about it as a macro exposure, because again, we don't do single stock research here at 42 Macro, but just talking about it as a big liquid macro exposure in terms of FANG names. On slide 12, overbought signal in the S&P 500, called that out earlier. WTI not actionable, although it's a lot closer to its upper boundary, its probable range than the lower boundary. Dollars oversold. This is something that we're calling out here. Nearly overbought in terms of 10-year break evens. Nominal 10-year, that's still bullish, but kind of in the middle of its range. High yield OAS just back to the lows, but getting close to being oversold, but not quite there yet. VVIX-VIX ratio, this thing is just recovering. I mean, that's positive at the margin. It's still bearish. I mean, that's why it's red. It's still bearish, but I mean, this thing is moving back higher. It probably will start to move back down, once the VIX comes off of a 15 handle, obviously. Low beta, high beta ratio, still bullish. I mean, this is a very clean cut bull signal with respect to the risk assets. What was not a clean cut bull signal, at least over the last couple of weeks, you had the small cap, mega cap ratio. That's oversold, or it's gone down. It's corrected. Same thing with the value to growth ratio. We were talking about this in mid to late September. Like, look, these things are starting to pick up and recover. That's suggestive that the market is getting more positive on the margins of growth. Well, the same thing is true in reverse. They're getting less positive on the margins on growth with respect to some of the data that's come in this week that, sort of was marginally disconfirming a bit of our post out the bounce view. We still think the view is the most appropriate view to have, but you do need to be aware that growth did come in. This is Q4 GDP expectations. So we were at 5.1 a couple weeks ago. Now we're at 4.8. So lost 30 basis points of growth there. This is Atlanta Fed GDP nowcast for Q3. We're only at 0.5%. The inventory could swing that to minus something. We had industrial production contracted 14% annualized in September. So I wouldn't be shocked to see a minus number. But again, the lower this number goes, the more it's going to bounce. But again, this bounce is expected. The consensus clearly expects a big bounce to 4.8% SAR in Q4. So clearly the balance of risk skewed to the downside from a market perspective, because again, all it means is this red line could continue to go lower. If the red line was down here, the balance of risk would be skewed to the upside. So this is something to call out. And also, and I think we talked about this in the lead off morning notes this week, but bottom up macro regime inflation, that's when growth is going up, G, and I is also going up at the same time, trending higher. That's not a done deal for Q4, right? Like stagflation is still the highest probability regime for most economies, the global economy, Japan here. It's still the highest probability regime, and it's still a very reasonably high probability for places where it's not the modal outcome. So we definitely need to be mindful of that. We're mindful of that by, being, not fully allocating, fully pivoting to reflation, but favoring, this grid zero balanced portfolio construction framework, which, by the way, is kicking ass and taking names. Make no bones about it. This we know. Investors are generally hedged for some of those obvious downside risks of growth coming from supply chain issues, stagflation, things of that nature. Investors are starting to get concerned about a policy tightening cycle as well. This is the this is the VIX curve. So this is the third month out VIX versus front month VIX. That's spread. So right now we're at a 3.6 on that spread. That's in the 92nd percentile on a trailing 5-year basis. And on a standard deviation basis, that's a 2.8 sigma move. So, investors are overpaying for protection on a 3-month forward basis because they look out and say, hey, there's a lot of boogeymen out there that can really sink this market and really cause an issue. But obviously it's something, this is Jim Carson does outstanding work on this and talks about it. Look, just the mere fact of this existing sometimes makes a lot of those risks void. Just the passage of time makes those risks void. Just because once investors are really hedged out there on that curve like that, a lot of times just the passage of time is all it takes to get those risks removed from the market. Because again, if you had a really low spread, then people would need to rush to buy protection at some point when something bad does happen. So it really does suggest that there is rally fuel on a trending basis. But again, a lot of those eyeball discounts on an immediate term basis tells you we're likely out of rally fuel and need to go back to the gas station. On slide 20, this we also know. Investors have near record amounts of cash on hand. Again, a lot of that cash, people don't want to buy bonds. You typically don't see a lot of cash when financial conditions are as easy as they are. So clearly it's telling you that investors don't want to buy bonds. This we also know, net liquidity supply is unlikely to inflect lower. And what I mean by lower is actually going down for at least another quarter or two. Tapering is going to take this thing like that. And then eventually the bully, next chart, the Treasury going to come back with its public debt borrowing binge. Again, right now we got 1.5 trillion dollars in overnight repo looking for a home. So at least the first couple months, if not a couple of quarters of that borrowing binge will be met with ample, with open arms, at least on the shorter end of the curve, given the moves we've seen and, all the way out to 5 years on the treasury market. But beyond that, you're going to really start to, once we get past that initial burst of borrowing, that'll be met well. We're going to get to a place where we're borrowing while, the Fed's balance sheet is actually now starting to go flat to down, or not down, but certainly flat. And so that borrowing will have a negative impact on net liquidity at some point. Again, we think that inflection lower, it's a mid to late Q1 event. Could be mid to late, could be Q2, could be earlier than that. We don't know for sure, but that's our expectation. On slide 23, just chopping the wood on the portfolio construction. Brent, crude oil, not actionable, defense overbought. Looking at Ethereum, both the crypto and the ETF are not actionable. EUSA is overbought. Eurozone's overbought as well. I think that'll be that'll transition back to a bullish FAM signal if a lot of what we're talking about from a medium term perspective comes to fruition. So we're hodling that exposure there. On slide 26, Bitcoin and the GBTC not actionable. Slide 27, mega cap growth, Nasdaq overbought, both of them equal weight. S&P overbought, gasoline nearly overbought. On slide 29 here is nat gas nearly oversold, uranium nearly overbought. And slide 30 here, so crude oil, USO, not actionable, broad US equity market BTI, that's overbought as well. Extended duration treasuries, not actionable, not quite at the, so again, you like to see treasuries down here with a bunch of sort of overbought signals in the equity market. But again, where they are in the probable range is telling you there's not a lot of, juice to the upside in bonds over the near term. So, it could be a nasty week from a portfolio construction perspective, certainly as we progress further into the week, as we get the GDP data. So, there's all kinds of things that could come out of that report in terms of the inventory cycle, things of that nature. Could actually see a negative print, like stuff that could catalyze a little bit of a risk off tone. But again, we think dips will be shallow. They need to be bought, in our opinion, until further notice. Slide 32, high yield credit, not actionable. 5 to 10-year tips, not actionable. Same story with EDV as TLT. And then lastly, dollars oversold. So expect a little bit of a disinflationary impulse if this thing does, in fact, bounce next week. And so that is it. Thank you for participating. See you next week. We are very, very, very grateful for you guys. Thank you so much. We've been making a lot of improvements with the lead off morning note. We hope you guys are enjoying that. Macro minutes, like the hottest free product on Wall Street right now. We thank you for that. And just generally speaking, the feedback has been excellent. So we continue to appreciate that. And we're going to continue to grow and continue to implement everything. Not everything, not all feedback is great feedback or something that can be implemented on a near-term basis, but we appreciate it anyway, because again, it's how we learn, it's how we grow. And at the end of the day, what we're really trying to do is help you make and save money. So with that, catch you back here next week, everybody. Thank you so much. Cheers.